When you have a breakout stock that's working really well, you may become a little nervous when earnings approach. An earnings report can sometimes sway a stock's price dramatically in a very short period of time. Additionally, when you have some winners in your account, but the market begins to take a turn, it puts you in a difficult position. If you have a winner on your hands and decide to hold it through earnings or a rough patch in the market, you could be risking serious downside reversal and give up some or all of your profits if the stock suddenly takes a nosedive. So, what are you to do? Well, one option is using put options to hedge your position. Sometimes taking profits in your winners ahead of earnings can be a good idea. Other times, that may not be what's best. Essentially, buying put options is the same as buying an insurance policy on your stock. Just like an insurance policy, you pay a premium, which is the cost of the option, for protection of your asset. You, as the homeowner, for example, pay the insurance premium. The option seller is like the insurance company. They receive the premium but take on the risk should the asset decline. Owning a put option gives the owner the right to sell their stock at a certain price no matter how low it goes. The downside is protected, while the investor still gets to benefit on the upside. The insurance analogy says it all, but just to really hit this point home, here are a few key reasons why you'd buy a put option for protection. First of all, a long put will profit if the underlying stock price falls, thereby offsetting any losses you'd have in the declining stock. Second, the most you can lose on the option itself is the premium that you paid upfront for it. Third, when long puts are combined with long stock, the overall position will be protected to the downside below the strike price. It will gain as the stock price moves up, but only after overcoming the premium paid for the puts. To visualize what we're talking about, here's a diagram to show how your losses are capped after a certain point if you have a stock with a protective put versus just having the stock. Without the protective put, losses are unlimited. With a protective put, your losses will be capped at the strike price of your option. The strike price of the option gives you the right to sell the stock at that price, even if the price of the stock is below it. So for example, if XYZ stock suddenly drops to 150, but I had previously purchased a put option that allowed me to sell the stock for 160, then that put option is protecting my downside losses from piling up. You can see how this would be very handy around an earnings report. Say XYZ stock is trading at 165 and the company reports badly overnight, sending the stock on a downward spiral to 100. I can still sell my stock at 160 a share and come out all right. However, you must still take into account the premium paid for the option to sell at 160. Now, when you're going to put on this trade in your account, you'll be looking to purchase an out-of-the-money put. Out of the money simply means a strike price that's below the stock's price currently. Similar to insurance, the deductible in this case is how much will be lost before the put protection kicks in. The further out of the money you go, the less expensive the option, but the higher the deductible. When buying your put option, you'll also have to pick an expiration date, which is usually between 1 and 3 months from now. After the put expires, it will no longer protect your stock. Each option contract is for 100 shares of stock, so one put will protect 100 shares. Almost all protective put buyers will sell their puts before expiration. If the stock is above the strike price, it can be allowed to expire worthless. If the stock is below the strike price, the put is in the money and the insurance is working, at expiration, it will be exercised and you are obligated to sell your stock at the strike price. Buying puts can be a great way to protect against downside losses, but it's important to remember that when it comes to options, there's always an added risk, and there's also the added cost that you must pay to own the put in the first place. Investors should take all of these things into consideration before proceeding.